G'day there, everybody. Thanks a lot for joining me on this Saturday, right? Market recap. As we say farewell to another volatile week's worth of trade. In fact, it was, technically speaking, the strongest weekly advance that we have seen since 1930 on percentage terms. Coincidentally, what is even more interesting is that as the initial unemployment claims, right, reached, 3.28 million, almost 3.3 million, right, lodged in the past week or so, technically speaking, the markets coincided with transitioning out of a bear market into that of a bull market. That just really encapsulates the insanity of this market. And at this particular point, really, these times of lunacy, insanity, volatility, hysteria, they really only coincide with transitional macro tops in not only the US financial market indices, but largely also the global financial market indices as well. The MSCI Industrial Index, I mean, all of these, they are all going through the same process. And it is largely a sign of the times. I mean, it's not my intention whatsoever at this particular juncture, if you're listening to me here on a Saturday or whether or not it is a Sunday, maybe potentially it's as we moved into the week of trade, as we say farewell to the month of March, right? Monday and Tuesday, and then welcome in the month of April being Wednesday the 1st. If you're listening to this video address, I just wanted to say a couple of things to you. There's a good chance that one, you're already in pro, which is good. Number two, that you have been listening to me for, I don't know, potentially a couple of weeks, potentially also a number of months, and in fact, a number of years. Often I receive emails of people who wish they have jumped into that pro class a lot sooner. I think at this particular juncture, it is quite a warmly reminder that we are, not only that we have, or we are, but we have also, at this particular time, right, transition from a macro market top, which is now priced into the markets as at the midpoint of February. That is now a thing of the past. There is no chance whatsoever that this market is taking out this swing high back on up here at the S&P 500 at 3,375. This is now that of a definitive macro market cycle top. Now, of course, comes the bounce, right? The inevitable clearing rally that a lot of people, I hope at this particular point, are not going to buy into the long-term legitimacy of. All right, this video right here is at this Saturday morning. I've just finished the pro analysis class. As at Saturday, it is recorded up on the website at this particular time. It really was a little bit of an introduction into mass psychology and what to look for over the coming 5, maybe 6, if not 7 months moving forward. I want you to understand right here, right now, that the markets, globally speaking, and also in the United States, they have formally topped, right? This is from the beginning of the macro bull market expansion. Since the month of March 2009, there is no chance these markets are moving back above these swing highs. And now comes, of course, the formidable right shoulder, which is going to mark the confluence of resistance, which will be up here. My best estimate is somewhere between 2,800 all the way up to 3,000 points. At that particular time, that is going to be the sayonara, so to speak, the right shoulder, which is going to coincide with the retest of the 200-day simple moving average. Okay, and then, of course, things are going to become a little bit scary. It's in your best interest, I can say, right? Sitting here, some will, some won't. I mean, it's a little bit of a mystery, but I don't need to really go into the detail of it all. I really believe it's in your best interest at this particular point to get a grasp as to what is happening under the surface of these financial market indices. We've got a very pronounced, a very sort of straightforward neckline at this particular point. Still expecting a little bit of weakness in the US financial market indices over the coming number of weeks. But as that plateaus and really defines that of what is going to be the right sort of point of that neckline, we are going to move into a sustained period of a technical bounce. This is going to coincide, obviously, on the weekly MACDs. All right. But really at this point, I mean, as I sit down and speak to you as at this Saturday recording, I really am welcoming you into that Pivot Point Pro analysis class that I've just recorded for you. As at, really only a couple of hours ago. Let me just show you this on the monthly chart. If I bring up the oscillating indicators, it's something I've pointed out privately, also now publicly. But if I just go into the annotations as well, and if I just hide them, just to show you the degree of which some of this divergence is forming. Very rarely, first of all, do you see this actually play out on a monthly chart, right? This is a chart of the S&P 500 on a monthly time frame. What I want you to pay attention to is, I'm just trying to actually remove, if I can, there we go. Actually, I'll remove the RSI and just keep the MACD open. All right, I've just tried to actually give you the degree at which we're seeing this divergence play out through price action up here on the top panel. and then obviously the MACD down the bottom. What we've established since the late period of 2017 into the very early period of 2018 on a monthly chart through the guise of the MACD is now definitive divergence. I mean, this is pretty scary. Very rarely do you see divergence to a magnitude, an order of magnitude that we're currently printing. Right? When you see, technically speaking, that of a sell signal on a monthly time frame on a market US indice, it's bad, not to mention, of course, the divergence that has been forming over the past 2 years through the peak in February of 2020. Now, again, I'm doing this for your benefit, not whatsoever for mine. Again, I'm just trying to welcome you into the family of Pivot Point Pro so you can actually get a grip of this and make something good of it over the next 5 to 6 months as we see this rebound rally. But as it stands right now, the last time we've seen the degree of which we're seeing the actual sell signals on the monthly time frame on the S&P 500 anyway, is all the way back, surprise, in the period of 2007, 2008. The reason why it isn't right applicable to 15, 16 is because if I actually put back on my annotations, we were still above that of the primary bull market trend line. That has shifted as at the month of March, although we are still delicately dancing all around it, above and below it. As most recently as Thursday, 2 days ago now, we were back above it. Friday, we closed down 3%. We're back down below it. There's enough evidence to suggest, pardon me, that we are right now in limbo. And as we move beyond that of the S-curve acceleration of this coronavirus pandemic, globally speaking, especially more permanently through to the US and also the UK, and even here myself down in the country of Australia, as we move beyond that within the next 2 months or so, a lot of people are going to tie into, this is my own sort of premise and thesis of how this is all going to play out, as we move beyond the worst of this pandemic, a lot of people are going to tie, right, the optimism and the buoyant prices of equities, right, the recovery, into the worst of the pandemic, which is somewhat true. However, there are going to be the lingering sort of hangover, the economic consequences as to what is going on around you right now. A lot of shutdown, not only obviously in the United States, depending on really where you are, if you're on the east or the west coast, or even the Midlands, the flyover states as well, but also globally speaking, there is going to be a price to be paid, obviously, for this shutdown. The Fed itself, okay, is pretty much printing an indefinite amount of QE at this particular point. They are saying, look, we're just going to sort of bankroll all of the liquidity needed to hold this market up. You've got all of the fiscal stimulus floating into the markets as well. Naturally, we are going to see a bounce. We've seen that play out, about a 15 to 20% market rise over the week just gone. Again, the biggest 1 week advance since 1930 on the back of this coordinated, right, monetary and fiscal stimulus, not only domestically in the United States, but also globally speaking as well. This is going to run its course. The biggest vote of no confidence that I spoke about earlier as well was, I believe, the 16th, this date right here, Monday the 16th. This was after that emergency meeting on Sunday the 15th, whereby, again, it was that record amount of liquidity injected into the financial markets, some of which is larger than QE1 to QE4 combined, albeit, right, calling it that of QE5, right? The markets, instead of rallying on that news, what they did, they vomited it up. They rejected it, and the Dow Jones Industrial Average on this particular candlestick just here, this was a Monday after, right, this announcement when the markets were closed, moving into Monday's session, pardon me, as at the close on, or at least on Sunday afternoon. The Dow Jones Industrial Average, it closed down 2,900 and I think 98 points. If I can just bring this up, have a look in the right-hand corner of my screen, 2,997. This candlestick right here says it all. So as you're looking at the charts, it may not be crystal clear as to what is happening right now, but overall, we are in some form of an intermediate basing pattern. Once this exhausts itself on the daily time frame, but more importantly on the weekly time frame, I understand people are still sort of working with this primary bullish trend line that, look, we may or may not be above at this particular point. I assume we're still going to see some weakness. We might actually revisit that of the weekly lows of the week just gone. But as we see the weekly oscillators push into extreme oversold territory, the countdown begins. And the reason for this Saturday video is because once that countdown begins, you've got X amount of time into the future to actually have a legitimate course of action, a plan as to how you are going to sort of navigate not only the US financial market indices, but even the domestic market that you may be transacting in, right? No matter where you are located around the world, because things are going to get very ugly soon after. I assume when you think about it, this is going to be tied into the US presidential cycle as we move towards the back end of 2020, which gives us potentially, I mean, it may actually happen before then, a couple of months before, but certainly 1 to 2 months after. If you're going by that sort of time schedule, it certainly is by December 2020. If not, it may even be prior to the US presidential election. Once really, I think it's going to be pretty much called before the actual date as to who is going to win this race. I don't think there really is all that much of a contest at this particular point. I think you can read between the lines as to who I believe is going to win, looking from the outside into the glass house of US politics. I think it's very much one-sided. I really think that it's a foregone conclusion that we are going to see a second term, right, for President Trump. But at some particular point again, and as, of course, we see the worst of this S-curve acceleration begin to plateau, which I assume is going to happen within the next 7 to 8 weeks, probably less even. We're going to have to follow, obviously, Italy as it advances. We've seen South Korea move beyond. We've seen China, even though I don't think anyone can trust those statistics whatsoever. But the more countries that move beyond the S-curve acceleration plateau and then move into, of course, the hammer, and then the dance, and the dance itself is going to be prolonged. I mean, that's going to linger for a very long time. People are going to tie in the optimism of that into equity prices, but there is going to be a handbrake pulled on that bounce. And I believe at that particular point, when we see price action tag certain areas that we've detailed over or in the weekend sort of class just earlier, I think we're going to see some very serious and very sudden reactions that are going to surprise a lot of people. I want you to understand where those areas are. I want you to make the best of it. And I am quarterly inviting you into that pro analysis class, not only for the weekend just gone, but also, right, over this transitory period whereby we have now definitively seen the end of this bubble, the bubble to end all bubbles, right? A bubble within all asset classes. Who would have thought that the coronavirus itself would have pricked this bubble? It now is the impetus. Now we're seeing, of course, the first substantive rally. That rally itself is going to produce the first macro lower high. The rest is going to be history once we take out this neckline. There is an orderly process to that, and it largely follows mass psychology. So if you want to learn more about the psychology of the market, what it means and what to look for in price action, again, I'm inviting you into that pro analysis class. I understand not everyone's going to take me up on that, but I really believe it's in your best interest to get a really solid footing as to what we are looking at. And again, it's only going to be limited. So believe me, you're not going to get an invite as to what the market is doing. Really, I think the most precarious sort of scenario or situation that you may find yourself in is putting yourself into a sort of a false state of hope as to, number one, the market's recovering back up into their all-time highs. That's not going to happen. Number two, unfortunately, is that if you think this is the worst of the sell-off, okay, this may be the bottom of the intermediate sell-off. I grant you that. Given, of course, 3, 4, 5 sort of months into the future, things might be looking, or at least seeming, a lot better than what they currently are. All right, I guarantee you this market is going substantially lower than this low over here. It's going to shock a lot of people as to how low and how far this market drags its feet, and for also how long that continues into the future as well. All right, not here to sort of shake anyone, just really to level with people who are here on the YouTube channel as well, publicly speaking, who want to join that private class. If you have any emails, email me, success@pivotpoint-trading.com. Otherwise, stay safe, everyone. All right, stay safe. Look out for your loved ones. Look out for your neighbors. Look out for yourself. If you're under lockdown, please observe it. And it might be a sort of a testing and trying period in time for yourselves. But beyond this 2-month period, probably things should begin to lighten up a little bit. And we may, right, at least I expect anyway, that we'll move back into a little bit of normalcy. In your lives, and also hopefully the lives of other people around the world too, in different countries that are on, right, a different scale of that on that S-curve acceleration. Okay, probably at this point we're looking at a May peak case sort of standpoint, right? Again, pay attention to new cases in Italy and the lag effect it's going to have, or at least the extrapolation of that. When you begin to see it turn down, and there is evidence that it is turning down, you're probably halfway through that. You can double the active cases, and that's probably going to plateau at some future point, which I, again, at this point expect is going to be May, and that's also going to be true for the US. It may linger on into June, but really at this point it'll be late May. Okay, we've got to get through April, May, and at that time I think people are going to wise up and begin buying this market for all of the wrong reasons as well. enough of that. I'm going to say farewell to you. Enjoy your weekend, everyone. I encourage you to have a look into that pro analysis class. All the best. It's James signing off on behalf of Pivot Point Trading. Farewell.